International Conference on Accounting and Finance.
Good afternoon. I guess it's afternoon already. And thank you for not yawning, for staying awake. I also want to thank the organizing committee. They've done a commendable job, I must say, of organizing this conference so far, what I've seen of it. And I've really enjoyed my few days here in Sri Lanka. It's so beautiful. I wish I could spend more time. The paper that we've done, I've done this with a couple of my colleagues at Western Michigan University. Professor Arugislan and I have worked on some dual class studies, unified versus dual class research. And he's a professor in finance at Western Michigan University. And Professor Saini is in the accounting profession. He's done some work on accruals quality over the years. And so we thought it would be a nice kind of merger between the two groups. And so we came up with this study basically to look at how ownership structure is related to quality of accruals, the working capital accounts of firms, and especially with respect to dual class firms. So that's our main focus, is the dual class group. I thought I'd talk a little bit about dual class versus single class. I'm sure most of you are aware that majority of the companies, probably 90% or so in the US, follow a one share, one vote type of structure, right? So you get the number of votes based on the number of shares you own. But there is a small but growing body of companies, like I said, about 10% or so, that prefer to go with multiple classes of shares. So we have Class A, Class B, where one class has no voting rights or limited voting rights, but more cash flow rights, dividend sharing, where the other class has more voting rights and less cash flow rights. And to name a few, Facebook, Google, wherever there's high technology, this has been more prevalent. And I think that is spreading even in Europe and, especially in the high-tech industry, okay? Now, the reason why companies tend to structure dual class is because, one, they want to entrench themselves so that they're not easily removed by the shareholders. And secondly, the founding company or the founding group, the family, would like to keep control. Obviously, it's a control issue, and they don't want to lose control by giving voting to everybody else. So once it becomes completely publicly owned, they lose control. And so that's primarily the motivation. But that's not what we're looking at here. We're looking at how does that affect accounting, and the way they report their earnings, and so on. So the motivation of the study is basically, as follows. There is obviously a growing popularity of dual class structure. It's small, but it's growing, especially, as I said, among technology firms, among family-owned firms, and a lot developing in European countries as well. Now, prior research on firm structure and firm value and ownership structure has been mixed. The studies going back to 1988, Grossman and Hart, said that if just one group is benefiting, then one share, one vote is good. But if there is shared benefits, then dual class is probably better. Another study by Harris and Raviv also said that if you're looking at hiring the best managers, one class, one vote is better. But if you're looking at the value of the firm, dual class is better. And then there is the issue of agency costs, essentially. And Jensen and Meckling came up with the agency theory issue, where if the owners are not completely committed, they might not necessarily make the best decisions for the large majority. And so, a study by Gerald and Paulson essentially found that post recapitalization, dual class, when the company goes dual class, the company shares actually drop. So there is mixed evidence. Some say it's good, some say it's not so good. Again, it's not completely determined whether dual class is better or not than single class. As far as we know, there was no prior study that looked at this particular issue of dual class and accounting quality, accruals quality in reporting. So we thought it would be a good study to look into. Now, I'll just summarize the literature. Basically, we have to look at two streams of literature. On the one hand, we got the ownership structure literature, the duality in the unitarian stocks literature, where, as I said, again, the results are mixed. And there is this agency theory issue, which says there is this issue of less than perfect information being given out. And then there is the firm-specific human capital hypothesis, which says basically that investors, founders sometimes find it difficult to convey the true value of their skill and of their technology, and therefore it's better for them to not give all the voting rights away and keep, because it would benefit the firm. And so we see studies by Farmer and Jensen, Dimitrov and Jain, and most recently by Chemanur and Zhao, that actually show that a dual class structure is better if you have got certain proprietary skill which is not easy to communicate to everybody. And so it's better for you to keep that control in the voting, voting power. Now, accrual quality, that's the other stream, because remember, we're looking at these two issues. I'm reminded of a cartoon I saw when I was teaching accounting some time ago, and the cartoon showed a board of directors, right? And the chairman of the board is saying, "Congratulations, folks." He's talking to his directors. Says, once again, we have managed to show positive earnings even though our cash flows have gone down. And below it read, the slogan read, "Gap or crap." And it was said, gap, you know what gap is. And crap was cleverly rigged accounting ploys, right? So, accrual quality has been studied, and essentially what they find, especially the Francis study of 2005, finds that companies that have better accrual quality tend to have lower betas and therefore lower cost of capital, and also their PE ratios tend to be better. Okay, so they are rewarded, in other words, with a lower cost of capital, lower discount rates. Studies on share ownership and accrual quality have been done more in the IPO, venture-backed IPO area and private equity-backed area. There is really not much in the dual class area. And there again, there is mixed evidence. What is found is, to summarize, basically in the private equity area, what they find is when there is more debt, like we were talking earlier about debt, the debt holders tend to demand more transparency, and therefore the accruals quality is better. Okay, so firms that are private equity backed but have more debt as well, or higher leverage, tend to have better accrual quality than firms that do not have so much of debt. So again, that shows that there is some relationship between companies' performance, value, and the way they report and they leverage. So the motivation for our study and the hypothesis that we developed essentially comes from three factors. One, we feel that as it is, dual class firms are plagued with higher cost of capital because of information problems, right? So we feel that they will essentially have to be more transparent, less earnings management, in order to show the investment community that they are, playing to the rules, and therefore lower their cost of capital. Because as you know, information is already on, the information availability is already an issue with them. People already suspect them, even though they may not be, dishonest. You know what I mean? So they are already basically starting from that negative stance. The second issue we feel is that based on the knowledge of the founders, if the founders want to essentially communicate their, or because they find it hard to communicate, they're probably going to be more, honest in their report, not honest, but follow the rules better and be more transparent and less managing, follow less earnings management of the earnings figures, okay, of the accounting, the accruals. Of course, the entrenched management issue, becomes less of a problem when you are dual class because you already are controlling it, so you're not going to worry about being, detrenched by the rest of the shareholders. So our hypothesis is, based on these arguments, that dual class firms will have better accounting quality, accruals quality, than single class firms. That's our hypothesis. All right, so the data essentially, we took from looking at the University of Chicago Research and Securities Prices, the CRISP data, and the SEC filings. And of course, it's a very long, and I was lucky that my co-author had the data because he used it for his dissertation. It's a very long process. Like you did, you had to go through LexisNexis and all of that stuff to find, because companies don't directly show that, as a variable. So you have to read their annual reports to figure out if they're single or dual class organized. So we looked at firms that were dual class before 1993, at least that's the data set he had. And we had 177 firms in all, okay? If you take firm years, and we looked at 1988 to 2006 because we wanted to have 5 years pre and post, rolling 5 years data in the term, we had 2798 firm years. We eliminated financials, so the 6,000 to 6,999 SIC codes, we eliminated them because financials have, as you know, assets and liabilities in the form of debt. And so, we wanted to, they're a different animal, so we eliminated them. Some of those firms, 177 firms, actually unified the stock after being, dual class post recapitalization. So we eliminated those, and that reduced the sample by another 149 firms. There were some missing variables, and we needed variables on, all of the accounting information, and so we had to eliminate another 1556 firm years, okay? And then again, we truncated the firms that are in the extreme first and 99th percentile, because of outliers. So we eliminated another 20 firm years there to avoid outliers, essentially. So we ended up with 711 firm years of dual stock firms, okay? Now, we wanted to compare dual class versus single class. So we needed a single class group. And so what we did was we tried to match from those firms that were not dual class a proper performance matched and size matched sample. And so we had to go through and collect companies that were similar in size, industry makeup, and, of course, performance of ROA based. And we looked at, for size, we looked at a 20% variability, because you cannot get perfect matches, no matter what you do, or you lose a lot of your sample. So it's plus or minus 20%, okay? And with that, what happened was when we looked at two separate samples, just to comply with what's being done in the literature. One group, was purely based on ROA performance, and that was 673 dual class firms that had data, and 638 of the match sample. And when we went down to ROA as well as size, what we had was fewer, obviously, 564 dual class firms and 528 match. So, not a perfect equal, but we've accounted for that in the regression. The sample distribution, again, the paper is on page 33 of your book, so you can follow. I know some of this is a little tiny to read. But if you look at the breakdown from 1993, to 2005, the number of firm years in our data set tends to reduce after 1999, basically. So 55% is between 1993 and 1999, and then 45% is from 2000 to 2005. Okay, so there's a slight, reduction in sample size, but overall, again, it's 673 firms for the ROA match sample and 564. And it's similar in both cases in terms of the drop in frequency. Industry classification-wise, the majority of the firms tend to be manufacturing, luckily, and we know that's something that you see a lot of in this industry, and service-oriented. So the 2,000 to 339.99 group, okay, the second two groups, and then followed by the 5,000 to 599, which is the trade, wholesale and retail trade. Financial characteristics. We wanted to look at various characteristics that have a relationship with dual class, composition or structure. And so we looked at the asset size, we looked at sales, we looked at return on assets, market to book value. So these are innate company characteristics. And again, what we find is if you look at the two columns there, basically dual class and match sample, in terms of at least the medians, are pretty much of similar characteristics. So we had a match sample that was pretty similar. In other words, it was not statistically different. Okay, it was in some cases, but when you look at the mean, it may be, for example, the mean size of the dual class group was less than the match sample, but the median size was pretty much the same. So what that tells us is there's a lot of variability, in our groups here. Okay. One of the things we also notice is the debt to equity ratio is lower for the dual class firms than it is for the single class firms, and that is significant in terms of both mean and median. And so that was an issue that we wanted to look at. Okay. Again, this is just for the other combined performance and size match, and it's very similar in terms of what we find. So, in other words, what we find is the two match samples are a proper benchmark for our study. How do we measure accrual quality? Well, there's a 2002 model developed by, they call them D&D, like our M&M in finance. We call them D&D, which is Dicho and Dichev model. And basically what they look at is, your operating cash flows, current, past year, and future year, right? So it's a leading lag type relationship. And then they also, McNichols modified their model in 2002 and added in revenue growth as well as property, plant, and equipment. Okay, so those are the 5 variables that we used in order to measure, and it's all based on, obviously, literature up to that point. So this is a well-accepted measure of accounting quality, accruals quality in accounting literature. Now, just to tell you, the expected coefficients are positive for last year's operating cash flow and future operating cash flow, and negative for current cash flow. That's essentially how Dicho and Dichev cite it. And the revenue item should be negatively related to quality, and the property, plant, and equipment should be positively related. Okay, so that's essentially what they report. Well, as you can see here, or maybe I misspoke. So we can see that for our sample, when we ran the regression, we found essentially the similar kind of coefficients as expected by the model, the people who introduced the model. Now, we have 2 measures of accrual quality. We have an absolute measure and we have a relative measure. The absolute measure is essentially to take the expected accruals based on the Dichev model and minus from it the actual accrual value, or the predicted versus the actual rather, and that would give you an absolute value, a number, right, a positive or negative value. And then we have, one of the studies showed that, say you've got high level of accruals. That is an indication of poor quality, by the way, right? But if that high level of accruals is consistently high and not a lot of variability, it could still be good quality. You see what I mean? So they are reporting high accruals, but they're consistently reporting high accruals. That's not necessarily bad. And so we looked at the standard deviation of the accruals, as is recommended in the literature, by looking at 5-year rolling quality values and computing the standard deviation. Now the standard deviation is high. That's clearly an indication of poor quality, okay? And vice versa. All right, so we ran a multivariate model. Okay, we ran a multivariate model looking at various innate and financial characteristics for companies, as you can see in size, standard deviation of cash flows, revenues. We looked at negative earnings reported by the company in the prior 5 years. We looked at the natural log of market to book, look at size, look at growth essentially, and then sales growth, debt equity ratio, and the profitability, auditor, who's auditing it, if it's audited by a big 8 firm. And also we looked at the industry, which is not in there, but the industry was a separate run. Well, to make a long story short, okay, let me tell you, we did find significant relationship between accounting quality and dual class firms. So dual class firms, when compared with the single class firms, had better accounting quality, no matter which model we used, okay? And so you can see that we've got 3 models over there. The first one, is purely dual class sample, and then you have the ROA matched, and you have the ROA and size match sample. And in all cases, you can see that the AAAC, which is the average abnormal accounting accruals level, is lower, right, for the dual class group, tends to get higher for the other 2, and it's significant. And the difference is significant, in other words. And so the asterisk tells you it's significant at the 99% level, okay? Most of the relationships were as we had proposed. And again, you can read more. I'm sorry I'm out of time. I really cannot. I tried to cut it as much as I could. But frankly, what I want to say is what we find is, contrary to what most people would have expected, dual class firms do not necessarily camouflage earnings, massage the earnings, manage the earnings. They tend to report better earnings quality-wise than single-class firms. And therefore, I think this is an important finding. People shouldn't worry too much about buying the shares of Facebook, Google, others that are becoming more and more popular these days in the technology sector. Okay? Just as a quick couple more things. As we said, the accruals quality is better than matched single-class control firm quality for dual-class firms. We find consistency in our results. The results are indicative of the fact that dual-class firms are concerned about cost of capital, and there's probably lower moral hazard problems with dual-class firms than is anticipated. And of course, we find that the founders here are probably doing so because they want to communicate to the people that they are, essentially holding some valuable skills, which is hard to otherwise find in the price model. Some additional study that you might be interested in looking at, and we're thinking of doing this too, is to look at the stock returns after controlling for quality to see if there's a difference in stock returns. Looking at comparison of cost of capital, to make a direct cost of capital measurement for dual versus single class. Look at executive compensation differences in that whole area, and of course the board of director characteristics in dual versus single. So just some ideas which we are looking at, and you can also maybe look at. And if anybody wants to do any work on this, please contact me. Okay. Any questions? Please ask.